What's going on, everybody? It's Monday, June 13th. It's a bear market, folks. It's a bear market. Headlines blaring that out today. It's officially a bear market. You gotta sell. You gotta sell. Folks, I don't know what kind of advice that is. I really don't know what kind of advice that is. I guess, when the market's down 20%, I guess the S&P is down 20% from its highs. And that's a bear market. I don't know. That's like the definition. I don't know who came up with that. And I guess that's advice. I guess they're telling you to sell now, which I am not doing. Actually, today I put some more money to work. Look, the funny thing is, like today, and by the way, today is Monday, so I did send out the new issue of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com. The link is right here in the description below. So here's the thing. When I went to my account and I'm looking like, okay, I'm going to buy some stock. We're down like 1,000 points on the Dow today. It's officially a bear market. So I'm going against that. I'm going against that. And I'm looking at my stock holdings. I'm looking at the stocks I have, the companies I have. Apple and CVS and Walmart and Nvidia and Intel and JP Morgan Chase and Citi, all these big name companies. And I'm like, what's going to happen? So yeah, we got inflation. We know why there's inflation. It's these damn sanctions and the supply chain issues. And the sanctions, really, if you look at the CPI that came out on Friday, the main driver in that, there were really two main drivers in that. When I say drivers, like the things that were up the most, those were energy commodities and mainly fuel. So you're talking about gasoline, you're talking about diesel fuel. And the other thing was airfares. The other components in the CPI, most of them were up. Okay, I give you that. But they were up on a much more, by a more of a moderate increase than we saw with energy commodities and airfare. All right. But anyway, so like I'm looking at, Microsoft, Apple, all these stocks that I own, like these are really, really, these are leaders in their field. These are big, massive companies. Some are $1 trillion valuations. They're on the forefront of innovation. They're not going to go away because airline fares are going up. I get it. Like everybody's freaking out and panicking. The other thing you got to understand about stocks historically is that stocks are a good inflation hedge. Historically, stock returns have beaten inflation. Over a long-term period. So you get a situation like this. For me, in looking at this current environment, it is about emotion. It is about hysteria. It is about people, just losing their heads. And they're scared. The poem If by Rudyard Kipling. If you can keep your head while others about you are losing theirs, you will be a man, my son. So that's what I think it is. Look, the Fed's going to raise interest rates on Wednesday. I said this was going to be a big week and a culmination, I think, of a lot of negative things coming together. And I said, like, the biggest thing for me this week, it's not the Fed meeting. It's not the start of QT. Like, I want the Fed to get on with it already. I don't think, just if you want to talk about interest rates, for me, hiking interest rates is not a cure for inflation. We've seen this all over the world in other situations where countries have tried to control inflation by hiking interest rates, and we understand it should be sheer logic that raising rates raises the general price level. So it's not gonna be because of rate hikes that inflation comes down, if it comes down. It'll probably be something having to do with energy prices correcting. Maybe we see some demand destruction. Maybe OPEC starts to pump more. we don't know yet. I can't tell you one thing as a side note that, every week I go over the CFTC commitments of traders report and I just check those positions. Now, producers, they keep selling into this rally. I mean, they have a net long position, and I said I would not go outright short the oil market until I see producers go net short, and they've been net long since last November. But now they have reduced their long position down to the smallest since the week ending December 7th of last year. So I mean, just like every week they keep selling into this, selling into this, selling into this, and reducing their net long position. So I mean, it's kind of like they see, we went up the first time to we hit like 130 or something, then we came down sharp, and now we're creeping back up. It almost seems like, they think this bounce back is not sustainable. They've been liquidating their long positions into this bounce back. But anyway, getting back to the stocks, you look at these companies, and they're going to be around. I mean, there's no two ways about it. I mean, inflation, no inflation, Fed rate hikes, QT, these companies are going to be around. And right now, the market is offering them at prices that are like ridiculously discounted. So I got to take advantage. Now, I can't do a lot of buying because, I'm pretty heavily invested as it is, but I was able to do some more buying today. The other thing I've been telling you guys that bothers me is, we got this quarterly corporate tax payment on Wednesday. Now Wednesday, all these things, like it's like, the perfect storm, because you got the Fed raising interest rates, you got the beginning of QT, and you have this quarterly corporate tax payment. It's going to be a drain of about 70 to 80 billion. And we know what happens. I mean, I explained to you and I pointed out to you back in April, the second half of April and into early May, when we had that huge, tax-related liquidity drain. Same thing going to happen now, just not as big as what we saw in April. In April, it was like 330 billion. On Wednesday, we're going to get like a 70 or 80 billion drain. So, I mean, that's not good. It's not good when the market is on the defensive like it is right now. I mean, whatever buying power would have been there right now, it's not that there's a lack of buying power. It's really that there's a lack of confidence. Like, people don't want to get in. I got in some today, like I said, but I mean, nobody wants to commit money in this because there's just like so much anxiety circulating around with monetary policy and the Fed and inflation, and it's getting pumped up in the headlines nonstop. And it also looks like the White House is out of control on this. Like, they don't know which direction to go. It's the Fed. And then Biden saying it's Putin's price hike, which everybody knows by now. That's just silly nonsense, The sanctions, here's the thing. I mean, the White House is very hypocritical on this, because there was an article I saw yesterday. I think it was on today actually. I saw on Zero Hedge that the White House is quietly asking companies to do fertilizer deals with Russia. Now, you just sanctioned Russia to, out the wazoo. Like, you made it so hard, and then quietly, hey, why don't you do some business with Russia? That's like, first of all, that's a blatant admission that the sanctions have failed, in the sense that they're hitting us. They're hitting Americans. They're hitting the global economy, not Russia. And number two, it's completely and totally hypocritical that now you're saying, hey, go do some deals, with Russia, when ostensibly the intent was to try to punish Russia. Now you're like, well, that's just the height of hypocrisy. But anyway, that's what's going on. So we know where especially when it comes to energy, look, if you deny yourself Russian oil, if you make it impossible for that to flow, who's getting it, by the way, is Asia. I mean, and I said, like, China's going to be the big beneficiary of this. India is going to be the big beneficiary of this. They're getting discounted Russian crude. Anyway, back to stocks. Another thing I saw today was, maybe some of you have heard of this guy, Professor Jeremy Siegel. He's at the Wharton School of Finance at the University of Pennsylvania. I went there, by the way, but it was a long time ago. He wasn't a teacher there at that time. So Jeremy Siegel, who, by the way, this guy happens to have a really excellent track record on the stock market. I mean, he works from valuation models. He's very rational in his approach. It's consistent. He was bearish in early in the year, January, February, March. I remember reading his stuff, and he was talking about, you know, how he was bearish because of Fed shift in monetary policy. But now he's saying, hey, you got to put money to work in stocks. Now's the time to buy. He's saying now's the time to buy. I pay attention. He's one of the few guys I pay attention to because his models, I mean, he's been really, really good. He's been excellent, as a matter of fact. So you have that out there. But again, if you think about it, inflation is not gonna end these companies. Okay, these are leaders in their field. These are important institutions, important businesses on the cutting edge of, you know, their industry, technologically, in terms of innovation, all this stuff. Leaders in terms of sales, in terms of market, you know, market impact, the size of their markets, etc. So, I mean, that's what I did. I looked down my list. I'm like, man, you know, they're all way down. They're all way, way down. And again, I don't know what kind of advice it is when, after the market has gone down so much that they, you know, somebody has come up with this idea that now it's a bear market, and I guess that means it's time to sell. I mean, I'm doing the opposite. I'm doing the opposite. You got to keep your head about you when others are losing theirs. You know, a lot of this is right now, frankly, extremely heightened levels of anxiety. If you were not to look at the stock market, all right, if you were to look at things like the fiscal flows, what I talk about here every single day, if you were to look at things like bank credit and what's happening with bank lending, I mean, if you were to look at those things, you know, separately, without being swayed by the panic and the hysteria that you see in the markets, you would say, hey, things are looking pretty good. I mean, fiscal flows running, trending to like 670 billion for the month. That's a really, really strong flow. Bank loans rising at the fastest rate in 2 years. All right. And that includes like commercial and industrial loans, which for a long time they were contracting. Now they're growing at the fastest rate in 15 months. I mean, we've seen a really nice turnaround in those things. Consumer loans still up there. Auto loans, which had kind of stalled out recently, picked up again in the latest data. So bank residual, which is bank capital, just had the biggest 1 week increase in 6 months. So higher rates, you know, flowing to bank earnings, to capital. So I mean, like, listen, I understand, like, it's easy to get caught up in the hysteria and the emotion. That's easy. I mean, yeah, I've been in this business a long time, and I'm not going to sit here and say that I'm not affected by it. I can get affected by it, but you have to do your best to stay unemotional, and you always need perspective. You always need perspective. Look, today the 10-year bond, the 10-year note yield hit what, 333 or something like that. I think somebody said it was the highest since 2011. I don't know. But if you look at a long-term history, a long-term chart of the 10-year yield, I mean, it's been going down for 50 years, 40 years, 40 years. It's been trending down. And this rise in the yield that we have right now, you know, it's a lot by recent historical measures. But I mean, in the big picture, if you step back and you get a big picture, it's still, I mean, you're talking about what are we talking about? Like a 1.25%. We're going to have a 1.25% Fed funds rate on Wednesday, maybe a 1.5% if they go 75 basis points. And you know, you got a 3.3% 10-year yield, 3% for 10-year. I mean, seriously, the market's gonna adjust to all this stuff. The economy's gonna adjust to all this stuff. I don't see anything in the average daily unemployment benefits. I track these, like how much is the government sending out every single day? Is that trending up, unemployment benefits? It's still trending down. You know what the number is? 77 million a day. I mean, that is nothing. That is nothing. Nothing. I mean, last year we were doing something like 2 billion a day, or you know, 1.5 billion a day. Not too long ago, actually. Now it's 77 million a day. So I mean, right there is, to me, it's a sign that the labor market is still strong. So I think all this is hysteria. I put some money to work today. You got to kind of work on just, first of all, it's not good to look at the market every single day. But it is good to understand that, you know, there are companies out there are businesses out there that they're going to be around. Inflation, no inflation, deflation, Fed rate hikes, Fed rate cuts. And if you understand that this is an opportunity, that you're getting a chance to, you know, buy these companies at greatly reduced prices. Again, I've said this so many times when I've given talks, you know, the American consumer is so savvy when it comes to personal consumption. I mean, we don't do anything unless it's on sale. That to the degree that we've literally made the retail industry cater to that behavior. Like they have to run sales to get us to buy. But when it comes to investing, people do the exact opposite. They buy when it's expensive and then they sell out when it's cheap. I mean, that's a very interesting twist in behavior that, you know, when you juxtapose that against how we are as consumers, it doesn't really make any sense. But for some reason, as investors, you know, we flip the behavior around, and that's just self-defeating. Anyway, that's it for today, folks. Have a good one. See you tomorrow. Bye.